Recently, big short investor Michael Burry walked back into the spotlight, banging the drum again. And the first thing he said was basically, this AI boom, the market isn't ready for it, and might not survive the fallout. And here's the crazy part. Not even 10 days later, Scion Asset Management, his own fund, suddenly deregistered and started returning money to investors. The whole world laughed at him again, just like they did right before the 2008 meltdown. Let's be honest. Whenever Burry speaks, the market instantly splits into two camps. One side treats him like a prophet. The other side thinks he just short sells anything that goes up. But whether you like him or not, one thing is impossible to deny. Burry always argues with logic, not emotion. He even says, I don't get it right every time. But his track record, still terrifyingly strong. Back in the 2008 subprime crisis, the whole world mocked him. And he was the only one standing when everything else collapsed. Later, he called Tesla, Cathie Wood, tech stocks. Some right, some wrong, but always based on reasoning, never vibes. And this time, he's not simply shouting AI stocks too expensive. He's pointing at something far more structural, something even many insiders avoid talking about. AI giants are buying GPUs like crazy, building massive data centers, but using unrealistically long depreciation schedules in their accounting. That makes the numbers look great, but the underlying risk keeps getting bigger. So what does that really mean? It means you think these companies are printing money, but the truth is, they're just stretching their costs over too many years. Think about it. A GPU running 24 hours, 7 days. Forget new models. Just physically speaking, 2 or 3 years is already pushing it. But on the books, companies pretend they can use it for 5 or 6 years. Of course the profits look pretty, but in year 2 or 3, when you actually need to replace those machines, the real cash drains out instantly, and your P&L falls apart in one shot. Burry estimates this trick, understating depreciation, could overstate AI industry profits by about $17.6 billion by 2028. His summary couldn't be more blunt. The AI industry looks profitable, but a lot of those profits are just accounting makeup. But here's the key point. This time is nothing like 2008. Back then, the money, chaotic as it was at least measurable. Bank leverage, loan books, default rates, CDO structures, a giant mess. Yes, but still contained inside the financial system. There were audits, stress tests, regulators. It was ugly, but you could still roughly estimate how big the hole was. This AI boom, different universe. Right now, nobody truly knows how deep the VC pockets really go, how much sovereign wealth funds are quietly pumping in, whether Amazon, Google, Microsoft can keep expanding CAPEX endlessly, how long OpenAI can keep burning cash, or whether there's nation-state money pushing everything from behind. And besides the depreciation issue, there's another trick that's even more shocking. Over the past few months, the US AI sector has been giving us one am I losing my mind moment after another. AMD had a day where it jumped almost 40%. Oracle shot up more than 40% in a single session. Even Nokia, yes, the old indestructible brick phone Nokia, had a day where it suddenly popped nearly 30%. Just think about that for a second. These aren't tiny penny stocks you find in the bargain bin. These are hundreds of billions of dollars companies. The giants, the mega caps, the ones that are supposed to move slowly. And yet, they're getting blasted up 30 to 40% in one day, as if somebody accidentally hit the fast forward button on the entire sector. It makes you stop and ask yourself, what on earth is going on here? Sure, a bunch of these stocks came right back down afterward. But that only raises the bigger question. What game are these tech companies actually playing? You can sum it up in one phrase. Circular deals. It's actually not hard to understand. In the simplest version, Company A puts $100 million into Company B. Then Company B turns around and uses that exact same money to buy Company A's products. The money just moves from the left hand to the right hand and then back to the original pocket. On the surface, everything looks amazing. A shows huge revenue. B looks like it has a massive customer. But in reality, they're simply propping each other up and inflating the numbers. In September, NVIDIA announced that it would invest up to $100 billion in OpenAI to build at least 10 gigawatts of AI data center capacity. On the surface, that sounds incredibly generous. But in reality, a huge part of that money will circle right back to NVIDIA as chip sales. Some analysts estimate that if the full 10 GW is actually built, OpenAI would need to buy around 4 to 5 million NVIDIA GPUs, which is close to NVIDIA's entire projected annual AI chip shipments. You can imagine how crazy this loop really is. NVIDIA gives OpenAI $100 billion. OpenAI uses that money to buy NVIDIA GPUs. NVIDIA earns the hardware revenue and boosts its valuation. It's literally NVIDIA funding OpenAI. So OpenAI can turn around and fund NVIDIA's own sales. Then comes the next loop. OpenAI announced a $300 billion cloud services deal with Oracle, spread across 5 years, roughly $60 billion a year. The contract kicks in around 2027 and is being described as one of the biggest cloud deals ever signed. To take on a mega contract of that size, Oracle has to massively scale up its AI computing power. So Oracle turns around and buys a huge amount of NVIDIA chips. Just the Abilene data center in Texas alone involves around $40 billion worth of NVIDIA GPUs. So the ecosystem ends up looking like this. NVIDIA invests $100 billion into OpenAI. OpenAI pays massive cloud fees to Oracle. Oracle spends tens of billions buying NVIDIA chips. The money loops back into NVIDIA again. It's a closed ecosystem where the same money keeps running laps. Now look at CoreWeave. NVIDIA owns about 5% of the company, and at the same time, CoreWeave is also one of NVIDIA's major customers. They signed a long-term cloud capacity deal worth $6.3 billion, with a bold guarantee. If CoreWeave can't sell all its cloud capacity by 2032, NVIDIA will buy the unused capacity itself. To build all that infrastructure, CoreWeave needs tons of GPUs. And of course, NVIDIA is the main supplier. Some of CoreWeave's biggest customers are Microsoft and OpenAI. Microsoft is a major shareholder in OpenAI and partners with NVIDIA. NVIDIA is both an investor in OpenAI and its main GPU provider. So once again, the money loops right back to the top. Then add AMD to the picture. To win OpenAI's orders, AMD offered what is basically a half-giveaway stock deal. If OpenAI buys enough AMD chips, it can exercise warrants to buy up to 10% of AMD at 1 cent per share. And the latest addition? Amazon. AWS signed a $38 billion, 7-year cloud deal with OpenAI, again involving huge volumes of NVIDIA GPUs. So the entire AI world starts to look like one tangled polyamorous financial map. Everyone invests in each other. Everyone buys from each other. And the same money spins between a handful of companies. NVIDIA has basically become the central bank of the whole ecosystem. According to analysts who reconstructed the deal network using Bloomberg's transaction map, the closed-loop circular flows among companies like OpenAI, NVIDIA, AMD, Oracle, CoreWeave, and Amazon could easily add up to more than $1 trillion. This whole setup can look like a new economic model if everything goes perfectly. But the problem is simple. If just one link breaks, the fire can spread across every boat tied into the chain. The last time we saw something like this, you have to go back to the dot-com bubble in 2000. Back then, Lucent Technologies, also an equipment supplier, kept lending money to telecom operators so they could build networks. And of course, most of the equipment they bought came from Lucent itself. At the peak, vendor financing reportedly went above $15 billion, while Lucent's operating cash flow was only a few $100 million. So when customers couldn't pay back those loans, the whole chain collapsed together. In today's AI version of that story, the weakest link is OpenAI. It's the company burning cash the fastest, with the least mature profit model. If one day OpenAI's cash flow suddenly snaps, there's a very real chance the entire circle goes down with it. Former Cisco CEO John Chambers said this current AI boom really does look like the dot-com bubble back in 2000, except everything is happening at about 5 times the speed, meaning the hype moves faster, valuations ramp up faster, money rushes in faster, and assets inflate faster. everything is basically on fast forward. And inside this 5 times speed environment, OpenAI is still losing money, a lot of money, based on Microsoft's latest earnings. If you work backwards, OpenAI probably lost around $11.5 billion in just one recent quarter. At the same time, according to reports from The Information and others, OpenAI internally expects to burn around $115 billion in total by 2029. So you've got this crazy situation where the revenue model still isn't stable, the profit path isn't clear, but the burn rate is already locked in on the spreadsheet. And that, more than the hype itself, is what makes this whole AI circular betting game so uncomfortable. Here's the thing. The real danger isn't just the valuations. It's the fact that society is simply not ready for the speed AI is coming at us. Chambers puts it bluntly. Entry-level jobs, white-collar or blue-collar, could disappear very quickly. And our schools, policies, and companies are nowhere near ready to handle that. That empty gap in the middle, retraining, relearning, people scrambling to pivot, that's going to be the most painful part. At the same time, inside the AI industry, you've got all these circular deals, inflated valuations, money flows nobody can fully track, and risks quietly piling up. That's why Michael Burry opens with a line like, "Sometimes the only winning move is not to play." He's not telling you to swear off AI forever. He's reminding everyone, AI itself isn't the problem. The real risk comes from the human side of the AI boom, the greed, the mutual price pumping, and the business models that are basically still storytelling. If you found this breakdown useful, don't forget to like and subscribe. I'll keep sharing clear, fact-based analysis to help you understand what's really happening in the global markets and how it connects to your own financial future. Stay tuned, because in a world this uncertain, having the right perspective is already a form of protection.